Am I racist if I get triggered by people who say my stocks that I'm invested into are absolutely trash because their CapEx reduces their free cash flow potential? Am I? The exact same people who only invest into asset-light software stocks, their portfolios are down right now 40, 50, 60%. So if you have ever felt frustrated before because people talk trash about your CapEx heavy stocks, well, I've got your back, because in today's video, we're gonna be talking about why some of the best performing companies in the world own hard, real, tangible assets, and why the asset light only crowd, they're missing the bigger picture. If you only invest into tech stocks, you might wanna pay attention. So between you and me, if you've already seen my portfolio, because I already showed it on the channel, you know that I'm actually a really big fan of CapEx-heavy, asset-owning business operations such as Hess Midstream, Lockheed Martin, ExxonMobil, Fastenal, Johnson Controls International, Eaton, and Walmart, to name a few. And to be honest, you have every right to push back. Because doesn't CapEx eat away at the free cash flow, and they're inefficient in scaling because they require more factories to be built in order to make more money? Amos, tell me right now, why do you like CapEx heavy stocks? It doesn't make sense. My friend, you're practically foaming at the mouth. CapEx heavy companies are not stupid, inefficient, whatever you were trying to insinuate. They're not just burning cash. Hear me out. We're going to be doing a working example with Huntington Ingalls, which is a core position in my portfolio. They're in the business of manufacturing and producing ships, submarines, carriers, and destroyers for the United States Navy and the Coast Guard. I mean, you would imagine with the massive amount of CapEx that they're doing on their shipyards and factories, they would be trash. That couldn't be further from the truth. Friends and family, it's not just Huntington Ingalls. Chevron, ExxonMobil, utility stocks, people that own real assets, dude, they print cash. I mean, what you see on your screen right now, I have 10 shares of Huntington Ingalls. My average cost basis per share is $169, and they're currently just shy of $400. My total return is 134% into the green after about 1 year of holding on to them. Let's take a step back and take a look at their financials and fundamentals a little closer. If we jump on over to the cash flow statement and we take a look at the line item, CapEx right there, capital expenditures, what does it say? CapEx, also known as payments for property, plants, and equipment that are depicted on the balance sheet as assets, it measures cash spent on long-term assets that will be used to run the business, such as manufacturing equipment, real estate, shipyards, factories, manufacturing hubs, logistics centers, and more. Right? So if we go back to the P&L statement and the gross sales, they generate $12.4 billion of revenue. And if you take a look at it, actually, their top line year over year, consistently up and to the right, it doesn't matter if the times are good or bad. The United States Navy and the Coast Guard, they constantly need new vessels, ships, submarines, prints cash. But anyways, $12.8 billion of gross sales in proportion to the CapEx of $400 million. That's a lot. And because of that, their free cash flow situation, it can't reach its full potential. Because if you were to remove CapEx, this number right here, $794 million of free cash flow, it would be a lot higher. And that's why when it comes to these CapEx heavy business operations, the free cash flow, it's not a useful metric. I mean, it's one thing you want to take into account, but it shouldn't be the make or break. Hear me out, okay? If we jump on over to the ratios tab and we take a look at the return on invested capital, I think it's right here, ROIC, it's 8.4%. Yes, I'm rounding up. Don't be that wise guy that's like, I can't trust a single word that you're saying because you're lying through your filthy mouth. It's 8.38. I get it. Let's round up. It's 8.4%. The reason why I even have to make that disclaimer is it happened to me in the past a week or so. Someone actually wrote that as a comment. The ROIC, it basically measures how efficiently this business is using capital. So when you take into account their total debt, all of their loans, and the shares outstanding, because you raise more capital by diluting the shareholders. And at an 8.4%, I'm going to be honest with you, it's not pretty, especially considering the trend of how it used to be in their golden days, 25 to 30%. To see it at 8.5%, it is a little disappointing because the golden standard is at least 10%. But that's not the be-all, end-all, because you want to measure the ROIC against their weighted average cost of capital, also known as the WACC. And it's basically the cost of doing business. As long as the ROIC is above the weighted average cost of capital, it's a good thing. And when it comes to Huntington Ingalls, their weighted average cost of capital is 7.07%. So it's higher by above 1%. So it means Huntington Ingalls, they're making more money on its investments than it costs them to run the business. In other words, for every dollar that they put to work for the business, it grows shareholder value rather than destroying it. Does that make sense? So right off the bat, besides their total return, we know that Huntington Ingalls, by the ROIC fundamental, we know it's high quality. And if we jump on over back to the P&L statement and we take a look at their shares outstanding situation, you would think they're issuing shares year over year, but that couldn't be further from the truth once again. Every single year they're buying back the shares, which means every share that you own of Huntington Ingalls, it has more quality because the quantity of it is not being diluted. But it also helps to artificially inflate the bottom line per share. It's basic mathematics, right? If you take their net income, which is the bottom line, how much profits are going into their pockets on an accounting basis. I say accounting basis because the cash flow statement, the free cash flow actually measures how much cash goes into the pockets. This, you can mess around with it. You could do tax write-offs, one-time this, accounting this, and you can artificially boost or decrease your bottom line. But anyways, you take $605 million of profits and then you divide it by the shares outstanding. So if there's less shares outstanding, so what does that mean? It means your earnings per share is going to go up. It's exactly what PayPal is doing right now. That's their business game plan. They're buying back the shares because they believe their business is inherently undervalued. So as you buy back the shares, it's going to pump up their earnings. But most importantly, when evaluating a military stock, a defense contractor, the line item, the metric that's the most important, pound for pound, is their backlog. How much unrealized revenue potential is there, predicated upon them being good on their promise and their end of the bargain. Like once we deliver this many ships, this is how much revenue is coming into our pockets. My fault, it's in the KPIs tab, Key Performance Indicators tab. Scroll all the way down. So their backlog as of right now is $53 billion. That's how much revenue they're going to earn in the future, and it's a backlog that's continuously getting bigger and bigger as they gain more contracts with the who? Who's their primary customers? The Navy and the Coast Guard. And as you can see, as evidenced by their history, it just goes up, 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 up. And their catalyst right now with the current party in power, they're trying to bring shipbuilding back to the US. Because in the past 90 years, we pretty much closed down all of our shipyards to outsource and to bring all of that shipbuilding overseas. China, Japan, Korea, and in certain parts of Europe, they're the ones that are building the ships. But we don't want to do that anymore. We want to build the ships. And so when we jump on back over to the income statement, $12.4 billion, this number is about to get a lot higher in the next 2.5 to 3 years. And don't even get me started on their dividend profile because it's absolutely juicy. I think my yield on cost, my dividend yield for the shares that I own, it's above maybe 3%. Pretty happy camper. So let me articulate, 3 reasons as to why CapEx asset owning businesses are high quality. So number one, their years of massive CapEx have led to shipyards and specialized equipment that give a huge economic moat from a new rival entering their space to give them a run for their money. You can't just DIY a submarine or an aircraft carrier that has about 5,000 to 8,000 sailors on it. You can't just go inside of your mom's garage or basement and make an aircraft carrier. You can't do that. Now, on the other hand, to be the devil's advocate, a software stock like Duolingo or Sprout Social, anybody with a few laptops can make a similar app to fight for market share. There's no barriers to entry except the laptops and making sure you're smart enough to be able to write lines of code. Software stocks, there's no physical asset moat. And with software stocks, if there's a will, there's a way to try and disrupt the big dogs. Now, obviously, you can't just launch your own language learning app and take away market share on day one. It'll take time. It'll take the customers to buy in, to leave Duolingo to join your platform. And the list goes on and on, but I think you get the point that I'm trying to make. There's no actual physical, tangible barrier or moat that separates Duolingo from the other 50 to 100 language learning apps that are sprouting up right now as we are talking together. And reason number 2, let's jump on over to their balance sheet because I want to show you exactly what I'm talking about. CapEx literally translates into the property, plant, and equipment, and it shows up as an asset on their books. $3.9 billion of physical assets that produce cash flow, and if things go south, they can absolutely sell some stuff. They can sell a machinery equipment here, a factory part there. However, on the other side of the argument, with an asset-light business, if things go south, you're left with nothing, really. Right? I mean, you might be mesmerized by the high margins and the fact that their overhead costs are not that high, but at the end of the day, you don't really own any physical assets. And that's why, if I pump the brakes myself, I really do resonate with real estate investors. I mean, coming out of my MBA program, I almost went into a real estate company, but I remember the hiring manager at the time, he was like, we don't take days off. You're gonna have to work 70 to 100 hours a week. And I remember thinking to myself, like, brother, that's just way too much. And so I ended up going to a Fortune 20 company's MBA leadership development program that paid exactly the same amount of compensation that the real estate investor was willing to give me with half the hours, 40 hours a week. Super simple. Funny story, now I'm putting in 55 to 75 hours a week doing YouTube. But that's neither here nor there, I digress. Owning physical properties that generate cash flow, you know, it might be old school and not sexy, and you might be like, but it erodes the net margin. All that is true, but it's tangible and it offers liquidation value. And for reason number 3, let's jump on back over to their cash flow statement and take a look at capital expenditures. People who think short term, they see CapEx as a cost, as a setback, as something that is negative. But people who think long-term and strategically, they understand that more factories, more manufacturing facilities, or in the case of Mag 7, more data centers mean more revenue potential in the future. Because for all we know, your operation right now, your throughput, you might be throttling your own potential. But by opening up another shop, it allows you to make more, to do more, especially in the case of the data centers. We have found out from the earnings in the past 2 weeks that Google, Microsoft, and Amazon, they could make so much more money, but their bandwidth is fully tapped out. They're at 100% capacity. That's why they have to make more data centers to make more money. Does that make sense? You have to set the foundation and plant the seeds today so that 10 years from now, you can harvest the fruits. You can't just magically make more money out of thin air. You need the physical assets that help you to get there. Unless, of course, you're talking about the software stocks. And in this video, I'm telling you, there's another side to that argument. And that's why at this point, you should understand that I do not think of CapEx as a negative cost, but rather as an investment. And while we're on the topic of unpopular opinions, I'm actually a huge fan of stock-based compensation. Hear me out. I know, you heard that? You rolled your eyes and you're ready to click thumbs down or X away. Because think about it like this. Stock-based compensation, it aligns the employee's priorities with that of the shareholders. They win if we win. In that, the stock price goes up, we're all going to be happy. If the leadership team has no skin in the game, they don't give a crap about making the right decisions for the business, because at the end of the day, every 2 weeks, they're still going to get paid a W-2. They're still going to be cashing in their paycheck. But if their compensation is directly tied to RSUs and equities, then they'll make the right move for the long term. Unless they're a genuine idiot that has no business being an executive team member. And if you've been following this channel for a while, you know those two opinions I repeat again and again. I love CapEx as long as it makes sense, and I love to see stock-based compensation as long as your free cash flow keeps up. And in a perfect world, outpaces the amount of stock-based dilution. All that to say, if you're 100% into asset-light software type of companies, and that's your entire portfolio, dude, I don't understand you. Like, I get the logic, but the idea of not owning physical barriers to keep away the competition, you know what I'm saying? And dude, I might be an idiot, but my CapEx heavy businesses, they've been pretty good to me as portfolio holdings. And I think it's just one of those things where you get it or you don't. Just like dividend investing, I can show you statistics and the facts all day long about how it's superior to other forms of investing, and other people will scream all sorts of excuses at me as to why dividend investing is stupid. I don't want to pay the taxes. It's inefficient. The company is wasting money because they have to pay you greedy shareholders, and the list goes on and on. You either get it or you don't. For some of us, everything that I just talked about here today, it makes sense. To sell lemonade, you need a lemonade stand. And paying for the physical stand is a-okay. That CapEx is going to return in cash flow and revenue. Now, having said that, I do want to defend myself by saying not all CapEx is a smart utilization of the capital of a company. If your current business model is declining and you're spending billions of dollars, kind of like case in point, let's pull them up, Oracle, and you're basically doing a Hail Mary, a make or break type of CapEx spending in order to be relevant in the future because your current business model is suffering, then I do not bless off on it. However, if that CapEx, it's on top of an existing operation to improve your economies of scale or your cost to do business, then I love it, especially if it's going to further your economic moat from the competition. That's an even better thing. If we take a look at Oracle, their revenue, 11% growth year over year, it's kind of respectable. Their legacy business helps a lot of our enterprise software and our data to be intertwined and connected. Like, that makes sense, but it's not really thriving, nor is it growing. And that's why they're making that hard pivot right now to be the data center provider for OpenAI and for some of the other Mag 7 stocks. So if we jump on over to the cash flow statement, take a look at their capital expenditures. That's pretty horrific, wouldn't you say? It used to be like, $4.5 billion, sometimes $8.6 billion, and now it's $35.5 billion, and that number's only going to get bigger. $50, $60, $70 billion to buy GPU chips from NVIDIA, to buy HVAC cooling systems from Aeon, to buy utility energy from Constellation, and to buy server racks from SMCI, to buy SSD from SanDisk, Micron. You see the picture that I'm trying to paint? They're going to be spending a lot of CapEx, and in the case for Oracle, dude, this one right here is super risky because as you take a look at their debt situation, it's $131.7 billion. And yes, it is as bad as it sounds. Because if we jump on over to the sustainability of it, like, is it manageable? It is absolutely not manageable. Because as we take a look at their debt to EBITDA ratio, the magic number is 3. Like, that's the standard. To take 3 years to pay off all of your loan obligations on the books based on your own core operating profits, 3 years? Not that bad. When it comes to Oracle, friends and family, their debt to EBITDA is a 4.6. Dude, red flag after red flag after red flag when it comes to Oracle. So with their CapEx spending, it's a little scary. They're making a hard pivot into who they've been to become someone that they're not yet. Another company that's doing a crap ton of CapEx in order to transform their business model is Intel. Right? Historically, they were known for their CPU chips, and they're losing ground every single day to AMD. And if we jump on over to their CapEx, it's $14.6 billion, and the year prior, $23.9 billion. It's billions of dollars because they have to build out their Intel foundries in order to compete with TSM. That's who they're trying to be. The chip builders for NVIDIA, for Marvell, for Broadcom. That's who they want to be, and it requires CapEx. So it's another company that's doing a Hail Mary right now, but for the past 1 year, 144% into the grain. I think the market's bullish about them because of their future potential. Because in the present tense, that's pretty horrific, right? Their gross sales has been shrinking since 2021. They're not actually a fruitful business, but it's their potential. And that's why when it comes to CapEx, not all companies are created the same, and not all CapEx is good. When it comes to Intel, I'm not gonna lie to you, if they can properly execute what they're trying to do, their game plan, they're going to be crushing so freaking hard in the future, and the US government has their back. They're not going to allow Intel to fail. Just like the US government will not allow other big US companies to fail because it's in the best interest of the US to protect them, right? Like Boeing, like Ford, the big banks when they went through the recession crisis of 2009, the US government's going to protect Intel. Anyways, Talking about debt, I feel like that's a metric we should have touched upon when we looked at Huntington Ingalls, right? Jump on over to the balance sheet. How much is their total debt when you take into account everything on the books? It's $2.9 billion. Sounds like a lot. Some of you might have tapped out already. Dude, that's unsustainable. That's ugly, horrific. Pump the brakes, my friend. Okay, the speed limit right here is 25. It's a school zone. Why are you speeding in a school zone when there's kids running around? You're a jerk off. But if you go to the ratios tab, the debt to EBITDA ratio is a 2.35. No matter how you spin it, manipulate it, pinch it, pull it, slap it, Huntington Ingalls across the board, all of their financials, fundamentals, and metrics, high quality dividend compounded with cheese. And that's why it's a core holding in my portfolio. Now, before you think I'm anti-software stocks, I'm really not. As long as they have an economic moat that's robust and resilient to AI, then I'm all for it. I don't think every software stock is going to be able to survive this AI threat that's coming out of the blue from Anthropic's cloud. Some of them, they're going to perish. I actually uploaded a video talking about those software stocks, and I'm about to upload a new video talking about which software stocks are better positioned to thrive because of AI. That'll be coming up in the next day or so. And I also uploaded a video that goes over the 8 different economic moats with easy to understand examples. If you like my style of teaching and the way that I talk and show you the information, dude, go and watch that video about economic moats. Because if a company does not have an economic moat, you really have to take a step back and ask yourself, then why am I buying into it? If I know that in the next 3 months or in the next 4 years, someone else is gonna come to eat their lunch. They open up the fridge door, your coworker already ate your lunch. There's nothing left in there. So now you're gonna have to do intermittent fasting until you go home. You're gonna be all grumpy when you get home because somebody ate your lunch. Do not go near companies that do not have an economic moat. That's not financial advice. That's literally just common sense, right? So, all that to say, what do you think of the tried and true, the utilities, the oil and gas, the medical equipment, and even the military stocks? I know I said a lot, but I asked that question in light of their heavy CapEx numbers because they're outperforming the markets for the past 3, 4, 5, 10, 20 years. Okay, changing gears for a bit. For those of you that don't know, I guess now you know, I do YouTube full time. I do it 7 days a week, about 8 to 10 hours a day, depending on what I'm working on, what project, what script, what editing I'm doing, 55, 75 hours a week. And I do that so I can stay at home to raise my baby, which, by the way, she's about to turn 4 months old. And dude, I know people talked about it. I thought they were just being dramatic and they're exaggerating. The sleep regression is a real thing, and it's been a sack tap. Like I'm just waking up and something just taps my left nut. It sucks. It's been rough, screaming, crying every 50 minutes to an hour and a half throughout the night. How do you think you could operate? Do you think you would be happy, energetic, if you are only operating off of like 3, maybe 4 hours of sleep? Life is pretty rough in that regard. But at the same time, it's also pretty rewarding. And I say that because I remember when I first found out that we were going to have a daughter, my wife and I didn't know what to think of being a girl dad because, you know, growing up, I always thought I was only going to have a son. Like most guys, right? We always want that kid. We can teach everything, mentor, turn him into a super athlete or whatever. But between you and me, being a girl dad is so freaking awesome. I'm not joking. Whenever she makes eye contact with me, she smiles. And she smiles to the point where my wife gets really jealous because the little baby just gets so happy to see me. Even though we hang out all day, something about this stupid face makes her laugh, smile, and brings joy to her. And all I'm doing is changing her diaper or feeding her. So it's pretty amazing. So all that to say, it's never too late to change your opinion or your mind on a stance, an issue, or pre-existing belief on anything in life. Because I didn't know that being a girl dad would be sick. And something else that I want to talk about because I have no one else to share it with, because you guys are my friends. The longer that I live in Japan, the more American and patriotic I become. I get it. The face is really Nigerian, but believe it or not, I do blend in with the crowd here in Japan. If I walk around, no one can tell that I'm American. Sometimes it's nice, right? Just be able to blend in and assimilate with the population. It might sound offensive and it might sound backwards and crazy, but Dude, I'm so freaking proud to be an American and of our country. And I love that as a people, we are delusionally optimistic and we're willing to chase our dreams and goals in life. You talk to people that are raised in other parts of the world, there's no such thing as going after your ambitions in life. And to be honest with you, I genuinely feel bad. And that's why when you think about being born as an American, it's almost like winning the lottery in life. So whenever life starts to suck or I feel sorry for myself or whatnot, I always remind myself like, dude, you're an American. The world is your oyster. Whatever you're willing to work hard enough for, you can actually pursue and attain it. So maybe it's an unpopular opinion, but we as Americans, we come from a bloodline of people that sailed on a wooden ship into the unknown for months at a time, or they cross borders to find a better life for themselves, but more importantly, for their families, right? It's in our DNA. Our parents and our families before us, they left everything in Poland, Italy, Hungary, Korea, Mexico, or wherever to chase the American dream. You cannot do that unless you've got a stubborn mental fortitude and perseverance to go through the suck in order to give your family a better opportunity. And that's why I respect the heck out of the American mentality and how we are radically optimistic. I love that we are a community and a society of immigrants. That's why if you go into a major city, you can eat delicious African food, Mexican food, Vietnamese food. And I'm rambling now, but I love it. So what say you? Having said that, I love you guys. Stay safe. Good luck in the stock market. And let me know how you feel about what we talked about today.